Welcome, everyone, to another exciting episode of the None of Our Businesses podcast and YouTube show. It's particularly exciting today because, as always, we are discussing the week's news in business, accounting, taxes, all of those kinds of things from three accountants' perspectives. And it's particularly exciting because we've got AJ Wheeler back on the program today.
How's it going, everybody? Good to be back.
And with us, as always, Charlie Zygmunt.
Thanks for joining.
And I'm Ty Carr. Well, we're going to get started with a few different articles here. We're looking at why accountants are leaving firms. Asian youth are lying flat. The research credit is now on the IRS naughty list. FAA takes on Virgin Galactic. All right, well, let's kick it off with AJ.
Yeah, thanks, Ty. So our first article this week is from Accounting Today, and it's by Chase Berkey, I guess. Anyway, 5 reasons staff are leaving your firm. So the headline kind of gives it away, but the first line is kind of interesting. Public accounting is engaged in a talent war. And so essentially it's an article, basically discussing what we've even noticed at our firm is that like good talent is hard to find. And especially in the public accounting realm, it's even harder to hold on to good talent. And so here's an article kind of laying out the 5 reasons why this author thinks that people are leaving public accounting firms and moving on. So the first thing is toxic leadership. So if your firm has a toxic leadership who create a toxic culture, kind of a no-brainer that, people are going to leave. So, and it was, it's actually listed as a primary reason for CPAs to bolt from smaller firms. Unrealistic workload. I don't know if it would be public accounting if there wasn't an unrealistic workload, but essentially it's saying that your staff has an unrealistic workload that is driven by the almighty dollar. So this is supposedly like a hyper focus on revenue growth and bottom line without proper investments in the staffing and technology that would hopefully, enable your staff to cut not cut corners, but cut time down on task. Third reason is compensation plan is lacking. So I was actually, back when I graduated college, I was kind of shocked at how much a Big Four accounting firm paid for a first-year audit staff. Now, in hindsight, I understand why they pay that kind of money because you have a big name behind you and stuff. But essentially, I guess if you have members cranking through 500 tax returns during tax season, and they're making salary and they're working 80 hours a week, they're probably working for less than minimum wage during that time. And then are they making it up in the off time? So number 4 is confusion about advancement, especially in public accounting firms. I can just speak from personal experience that, it can be obtuse as to how you move up in that system. At least at the firms that I was around or had friends that worked in, it was very kind of like a walled garden. You didn't know after you made manager, where do you go from there kind of thing. So you knew the steps maybe to get from staff to senior to manager, but after that it was anybody's guess on how you hurdle that last step. So, and then 5 is no to self-determination. I found this one kind of weird, but your staff doesn't have the autonomy necessary for self-determination. So it kind of goes into like, I guess, talking about some people like being given the program so they don't have to make difficult choices for themselves, essentially like a step-by-step play. And then, and it says these people can actually often make crappy firm partners. I think, it's kind of goes back to the old thing. If you give your staff the kind of work balance of being engaged in what they're doing and really loving what they're doing and giving them the, I guess, space to work in that, to work out things on their own, it's much more engaging. But I'll open it up to you guys, I guess. Does any of these 5 points seem, off base to you or surprising, or did they maybe miss like a large kind of chunk of why people are leaving or why it's so hard to find and keep good talent in the public accounting space?
I mean, I think these kind of sound to me like they're right on, but I do have my own take on them coming from the other direction of being a firm leader. And also in terms of, I think there's sometimes things people say they want, but then I would kind of ask, well, do they really want that? And just kind of putting in the context of some of the conversations we've had in our own firm about our own people and talent and how we recruit and things like that. So, I mean, I think in terms of toxic leadership, I would hope to say, being the head of our firm, that that we don't have that, but that might be self-serving to suggest that. But certainly I'm cognizant of, I've experienced it before, so I'm cognizant of what that looks like, and I try to avoid that. The unrealistic workload, it's an interesting thing in our firm because we have, being an advisory and outsourced accounting firm, we have some projects that are done on fixed fees and some projects that are done on a rate per hour basis. And I feel like, I guess from my vantage point, I feel like maybe I'd ask you guys this question back. We have a banter about this point, but I feel like the stuff that we do rate per hour, we don't have as much of an unrealistic workload problem with. The stuff that we do the fixed fee on, I feel like we kind of get into that problem the same as other accounting firms. And, I wish it weren't so, but I feel like maybe I have had some unrealistic expectations in terms of workload in some cases because of that. But yeah, on that particular point, what do you guys think about my theory?
Yeah, no, I mean, I think you've got it right. I mean, having it be based around rate per hour feels like a lot better way to manage that workload. It still can be tricky, to be honest, because built into that, you also have expectations as well. So it's like, on the one hand, yes, you have set up a per hour kind of a deal, but then you're also trying to gain buy-in from the client and from other parties about how long something should take. And sometimes without them having that expertise of how long something would take, you have to sort of either educate them or really just explain your stance on it. And so there still can be an expectation, a gap between what's supposed to happen and what ends up actually happening. But I do think that having it be on a per hour makes it a lot more easy to handle. I agree with your point about the toxic leadership. I mean, that's definitely the primary thing that, when I go to look somewhere where to work, the first thing I ask myself is, could I work for this person? And if you say no, none of the other parts matter. None of the other questions mean anything, because I wouldn't take a job at any rate of pay if I didn't feel like I could work with the person who I know that I will be working with. And so, yeah, I think the article hits it right on the head. And those are kind of my thoughts. What do you think, AJ?
Yeah. So in regards to Ty's question about the unreasonable workload, I would say, like, when we're talking just about our firm, if you have an unrealistic workload here, it's of your own doing for the most part. You've taken on you've said yes to too many projects, especially from an hourly standpoint, or, just to like peel the hood back and show everybody, how the sausage is made. When you're working on a client, we're estimating the hours needed. So if you have an unrealistic workload, that probably means that whoever was estimating the hours or the work to be done was done incorrectly or done, or we missed the mark on that, I guess is the correct way to say that. So, and it's something that we worked on internally to try and better estimate how long tasks are going to take, and aligning somebody that's good for that job to be a quick, we always talk about quick starts. We always want to be a quick starter. We want to be able to solve problems quickly. So it's usually like low hanging fruit, like in the beginning. And then those more difficult, complex problems can lead to the longer time period, and maybe an underestimation of how long that's going to take. But at the end of the day, I guess an unrealistic workload would be your own doing at an hourly rate. Now, on a project rate, or a project or a fee arrangement for a service, that can be different, right? Because you can think you have uncovered all the rocks and seen all, you've laid bare everything that might be a problem in that situation. But like, I don't know, using R&D tax credits as an example, we have an article coming up about it, but like, you think you've laid bare everything and you present this and you think you're going to have a fee based on what you would get back from that R&D tax credit, because you're doing a back of the napkin search of time and then effort put in and how much the client is going to get back, and you're basing your fee off of that. You could land in a situation where you have an unrealistic workload, because as you uncover the real rocks and looking under the hood of that company, you realize that there's a lot more work to be done to figure out the valuation of that R&D expenses that are eligible, or you have a lot more leeway in getting to those expenses and identifying them than you initially thought, using that as an example. So I think, if we're talking just about hourly, I think it's really dependent on the person bidding the job and the person that's accepting the job to have realistic expectations around the time it takes to complete something. And, you're probably in a situation where you have an unrealistic workload in that situation versus I don't know how you would go about the value billing side of that where you're doing a project, because you don't know until like, and so I think, yeah, but in a
100%.
public, yeah, sorry, go ahead, Ty.
Yeah, no, 100%. I think that's exactly what we find is that fixed fees and value-based pricing works when the objective of the engagement is advisory. When the objective is to be available to provide somebody with advice, then the fixed fee kind of value-based pricing process works. But when the objective is delivery of accounting work, I don't see that it works well. I think you can do it. Like if, for example, if we had a small accounting project where we kind of know what the deliverables are going to be and it's maybe going to take one person, can we get to a reasonable estimate of the hours and then fixed fee it? We can, but where we get whipsawed, and I think that this leads to this unrealistic workload in our scenario situation, is when we've got complex accounting engagements where we're deploying 4 people, to try to do the accounting for a business or to clean up some businesses' accounting. And I'm sitting here like trying to estimate what I think the total hours would be and then give a fixed fee for it. Actually, when you think about it, it would be I would be amazing if I could actually come up with a fixed fee that was going to work and actually cover the hours of 4 different people who, can go wrong, go down different paths, all kinds of, and I think that's what happens is that we kind of get ourselves into an unrealistic workload scenario when we do that. So I'm definitely like, I'm on the page right now. I mean, I'm being very transparent with our audience here, but in terms of how we go to market and price our engagements, I'm looking at these things and thinking, yeah, I'm probably going to not do as much fixed fee type stuff when it's outsourced accounting delivery type work, because of that exact issue, because I think I'm putting our team in a position to have an unrealistic workload to try to meet the budget of a fixed fee that I created for this, which I wasn't really suited to do when it was that variable to begin with.
And I think it speaks to kind of like the difference in our firm compared to like a traditional tax and audit firm, because a tax and audit firm, you're offering this service, right? And this service is denoted by like either the tax preparation or the audit that's being performed, right? And those are very like regimented, compartmentalized process, like deliverables, I guess, for lack of a better word. You're delivering an audit, you're delivering a tax return, right? Where in our business, especially with the outsourced accounting portion, you are delivering something to them, but it's much more of a collaborative work between like the business that we're contracting with and ourselves. And so that back and forth and the amount of time that it takes often not necessarily doesn't fall on the team member that's performing it. It's a combination of how much you're able to get done with the other person that's at that company. And so I think the hourly rate provides us some kind of leeway in, like we think it's going to take 20 hours, but it could possibly take 40, just depending on how responsive the client is, how much access to information we're given, how the quickness in people turning around the questions and the requests, if you don't have hands on everything. So, there's a lot of variables there that would be very hard to fix bill for in that outsourced accounting kind of example.
Right. Yeah, I want to throw down some other thoughts about some of the other points that were in the article. Compensation plan is lacking. So this one, I definitely have an opinion about having been a partner in a small accounting firm and worked with lots of different accounting firms and networking with all kinds of accounting firms. I think, I think this is an issue. And one of the things that I hear, I guess my fundamental belief is if you want to attract and retain talent, you have to pay market. Or in our circumstance, we have compensation structures that really are fairly entrepreneurial. So a lot of our people are essentially partnering with us in a way. And without disclosing too much about that, I mean, ultimately, though, however we structure that, the target that we're trying to hit has to be within market, right? That's what I fundamentally believe about it. And what I remember, I've had this discussion multiple times with different partners of different small firms that will take this position that, well, because our firm charges, our firm can't pay the same market for talent as a large firm, for example, because we're a small firm and we charge our clients less money. And I think, to me, that argument just never really made any sense, because it's like, well, so are you telling me then that your intent is to actually find people who are less qualified or have less, are somehow lesser because you've decided that because you're not going to compete in the market at market rate for talent because your clients pay less money? I mean, at the end of the day, if you want highly qualified talent, you have to pay market, whatever that is. The fact that your clients pay less money, that's a decision as a business operator you made to go to market in a market that pays less money. And that's okay to do, right? But as a business operator myself, if I'm going to market with the group of clients that pay less than other clients, whatever comparison I want to make there, then that's I consider the cost inputs to be a fixed thing, right? They are what they are at market. And the fact that I am competing in a marketplace for clients that pay less means that I've decided as a business operator to take less margin. It's incredible to me that some firm operators think that they can get top talent, but they want to have that talent bear the cost of their choice to go after lower margin clients. I mean, that's not the employee's choice. That's your choice as the firm operator. And it's a fine choice to make. I don't dispute, people, a lot of firms, we work with nonprofits, for example. A lot of firms focus on nonprofits and they look at it and they say, well, look, maybe the fees for nonprofits are going to be lower. A lot of people will focus on small businesses or other industries where the fees may be lower. That's fine, but that needs to be incorporated into your business strategy and what you're accepting as your margin, not incorporating what you pay your people. So that's my take on this compensation plan issue. What do you guys think?
Well, just the other thought I had was just that a lot of times, both in the compensation piece and also in the value bidding piece, when you estimate high or low and you end up not hitting that mark, either direction doesn't always work out for you. It's easy to look at it and think, oh, well, if I bid high on a job and then I get through it, that I must have won. But ultimately, the client knows what he paid and what value he received. And the same is true of the employee who's working for whatever level of compensation. So a lot of times, even when you think you got away, not you, but the world thinks they got away with something either on the employer side or the employee side, they're just they didn't actually. Everybody involved knew what was going on and everybody stomached whatever it was, and they might have gotten through it, but they choose next time to go somewhere else or to do something else.
Yeah.
And so it really doesn't matter a lot of the times that you think you got away with it. If
people are keeping score somehow, there's a ledger in the back of people's minds as to, okay, that's what happened this time, and you're not gonna be able to continue doing that at scale over and over again.
And even at the time, even when you're just actively working on it and doing the hours, if you're deployed in a place where you don't feel you're being compensated fairly, then you just solve for it right there in the work. So maybe you're not holding a grudge, but maybe you just don't work as hard as you maybe would have had you felt adequately.
100%. Yeah.
And so sometimes it's a quick thing. It just happens, immediately. And so that's the only other interesting thought I wanted to kind of share on it.
I would say that I think a public accounting firm can probably find top tier talent at a lower cost, but where you're going to find those people is in like a staff role. And the minute they get enough experience, they're going to bolt for greener pastures. You have to make it attractive for them to stay with pay that is market level, and to Ty's point, you need to bid your jobs at a correct dollar amount where all the work can be done. I mean, I can remember when I was in a public accounting firm, sometimes I'd look at the engagement letter and I'd be like, okay, what part of the audit do you not want me to do? Like there's not enough money here in the budget to get all this done. Oh no, it's easy. So I think it's twofold. I think you need to identify good, there's nothing that says you need to pay top dollar for a staff accountant, but I think you need to pay top dollar for a staff accountant that's proven themselves to be a high talent individual or a highly sought after individual. I mean, let's face it, the reason this article is wrote, and we've run into this, is good accounting talent or good accounting talent. Well, that's a mouthful. It's hard to find these days, and like people that are able to be client interfacing, smart about their accounting, have a depth of knowledge in their area, and are worth their salt in the accounting world are, that's a really solid combination of skills. And like those people are going to demand top dollar, and they're going to take a long time to find a good job. So if you want to keep them, you have to pay them properly.
Yeah. So moving on to another point in the article, confusion about advancement. So I think this one is, they point it to making partner, but on a superficial level, I would take exception with that having been a partner in a local firm, a small accounting, traditional CPA firm, and now running the firm that I run, that I don't see a lot of folks out there that want to become partners, that want to become owners in the business with me kind of thing. And I think, but I think what this is getting, I think that's just the wrong way of framing that point. I think that what that point really is, it's not that people don't, I think there is something going on in the world of the accounting industry and the generation now that is like, yeah, I don't know if I want to be an owner in that business, right? And I think that is a real thing that we're all facing. So I don't think that a lot of people leave because they don't know how to make partner per se. But when it comes to advancement, what everybody, of course, wants to know is how do I make more money? How does this improve for me, right? How does my life improve in this situation? How do I make more money by and not necessarily work anymore, by not necessarily working more? How do I potentially work less and make more money? And also, how do I continue or develop the ability to do things that are, if I'm not doing things that are incredibly interesting today, how do I develop the ability to do things that will be more interesting in the future? I think it's those things, right? That maybe maybe this article and this author attached those attributes to being a partner. But I think I think this next generation is smarter than we are in the sense that they don't give a crap about being the partner. They care about the attributes. They want the money, the work-life balance, and the interesting work part about it, right? I mean, am I wrong about this, guys? You tell me.
I think you're exactly right. And I'm going to use it as an opportunity to lead into our next article because I think that it's a really fitting place to put it. There's an article in CNN called "Exhausted and Without Hope, East Asian Youth are Lying Flat." And so it's an article about this exact point. It's talking about how people in different Asian cultures, it talks about a few, it talks about Japan and in China and a few different places, but more generally, the kind of trend that they're seeing is that people are getting fed up with the kind of work-life balance that has been, touted all along, and they're deciding to do less, live on less, and just learn to exist on less. And they've coined this phrase for it that they call lying flat, and they're just going to kind of try to not, be a part of things, just kind of step away. And I think it's a little bit different than the point you're making, because a lot of the people that you're talking about just want to make more and do less. And these people are instead saying, okay, I want to do less and I'm willing to live with less in order to make that happen. But I think both stem from that same desire to want to have a different level of commitment or being involved in their work. They want to work less, whether that, is by making more money while they do it or just by doing less. And so I think it's a trend that we're seeing around the world. It's a trend that I hope doesn't take hold too much here in America, because I don't, it doesn't seem great to me that as a society, people are deciding to do and just abstain from the entire process. But I think it's that same trend. And I want to get your guys' take on, I guess, do you guys think work ethic is becoming a thing of the past? Is what we're seeing in these kind of Asian countries going to be a trend for other nations? Or is this an isolated kind of an incident?
I don't think it's isolated. I think that, but I do think what I will attribute to Asian countries, and particularly my wife's Chinese, and I'll throw out there that one of the things that I love about that I love about Chinese culture that I see, maybe you see it other worldwide as well, but I particularly see it in Chinese culture, is they're really great about like coming up with a term for a cultural phenomena, right, that is going on, right? And I think we've seen this in prior podcasts where we've had terms that came out of China. And so this lying flat is giving a term to something that I've observed in young people that I work with here in the US, in the sense of, and I don't know that it's a bad thing. It's this kind of sensibility of, I don't need more. Like, I think, particularly in American culture, we, and I think that there's a lot, and I think that that's also reflective of, it's also seen a lot in Chinese culture. I think that's one thing that Chinese culture and American culture have a lot in common, is this constant, like, more, this drive for more kind of thing that is kind of in our cultural DNA, and for both of us. And I think this idea of, yeah, I don't need more. I'm opting out of that. I don't need more. I need what I have, and I'm happy with what I have, and I can survive and live off that. And I'm opting out of this whole idea that I'm going to constantly strive for more. And yeah, I have to say that I personally have totally been ingrained with the always striving for more. So I've always found it, like, difficult to relate to, but I've also found it fascinating to, like, talk about and try to study in the people that I know and the people around me, to see kind of where they sit on that. So yeah, I don't think it's uniquely Chinese, lying flat. I just think coming up with a term for it is a Chinese thing to do. And I think that's great.
I always thought lying flat was what happened when I got done partying when I was 19 and 20, but but no, I think, and just speaking from personal experience, I think a lot of times when we think about moving up, or like Ty was talking about earlier in that first article about confusion about advancement and partnership or whatever, I think the big thing is to feel engaged and have some kind of say in what you're doing makes more of a difference than, like, title. Pay, of course, leads into that. But, like, I mean, I can just speak myself. Like, one of the big things when I got out of public accounting was, like, okay, now I get to direct myself, especially in the position that I'm in now. I have a say over which clients I get to take on, what continuing work I get to do. And that's huge to me. I mean, the pay is great too, but I think having some kind of say in what you're doing and how you're doing it means a lot more than, like, this is, you got 5 more clients. Well, how the hell am I going to squeeze that in? And I think that and I think that's a part of this lying flat, is they're making that decision themselves. Like, hey, guess what? I may just be like a shift manager, but I'm going to be the best darn shift manager there is. And I'm only going to work 30 hours a week, but I have a say in what's happening, so I guess they're manifesting that, like, ability to be able to dictate what they're doing and have some kind of, like, control over their work schedule and their work product, by saying that they're going to remain flat at where they are, And so I guess for me, and I don't know, and I'll put the question out to the group, is I think that matters more to me, having some kind of say in what I'm doing and how I'm doing it, as opposed to, like, title, even pay to a certain extent, you know what I mean? Having some kind of, like, control over what I'm doing makes a big difference,
No, I think that's huge. I mean, yeah, that drives everything that we do, is feeling like you have some freedom in what you're choosing to do. But I mean, I just think it's interesting, because in the article it talks about, because as I'm with you, Ty, I think that in general, if you're just, want more for the sake of more and it's pure greed, then okay, that's one thing. But if you're strictly, I mean, in the article, they talk about people saying, I'm not going to marry, I'm not going to buy a house, I'm not going to have a children, I'm not going to buy a bag or a watch. And so they're taking it to a level that I think maybe goes beyond the idea that we can all drive to work in a little bit more of a beat up car because we don't need something nicer. I mean, I think that to me is like just a work-life balance type choice. And then the idea that I'm just going to abstain from, marriage, house, children, and clothes, furthermore, as a whole, is like maybe taking it, a lot further than I would have guessed, I guess.
Yeah, that is an extreme response. But I'd have to say, in other work that I do and other entrepreneurial endeavors I've worked with a lot of different young folks, and it's interesting to see. I think that exists. I think, I don't know that people necessarily define themselves that way. Like they don't necessarily. What's interesting here is that maybe these folks that are adopting that saying lying flat, they're actively saying, I'm doing that, but I've met people who are effectively doing that.
I'm still reminded of like I think I read an article or something, quickest way to being rich is to live like a college bachelor, even when you're like well into your 30s and 40s. And what does that mean? It means you don't have any decorations in your house. You're not arguing with your wife about paint colors, you're like
Right.
got a single couch, no pictures, no love, laugh, life, like knickknacks around the house. You're living on the bare minimum. And in that case, $20 an hour is like, $100 an hour because you don't have a lot of expenses, and it's giving you the freedom to be able to like retire when you're 30. I mean, we live in Portland, right? Where 30 somethings go to retire, as the saying goes. But I mean, if you live like that, it gives you a lot of freedom in what you're looking for. So, we're talking, I think, about two different sides of the teeter totter, right? You either make more money or you live, less luxuriously, and you forego a Tesla and a big house, and you live with a futon and a beat up Honda, so I think it's, two sides of the same coin, I think.
No,
all right. Yeah.
Yeah. You've got another one we can talk about?
I do. So this one, all right, this is for the tax nerds out there. So Voices and the IRS list the R&D tax credit among its dirty dozen. So is it still safe to claim the R&D credit? All right, I picked this one specifically for Ty, so I knew he had a lot to say about this. But the IRS issued their annual Dirty Dozen Scams list, and it's designed to warn taxpayers against abusive tax promotions. So one thing that happens in our industry, and it's a bit like an ambulance chaser lawyer, I guess, but they have firms that I guess specifically target like R&D credits. And we've had this happen in the I actually had a call from a cannabis client that we had where they were aggressively targeted for these R&D credits by a firm like in Florida or Connecticut or something that did this throughout the country. And essentially what they're talking about is the credit that's increasing research activities. It was first established in 1981. It can be a large credit to a business's tax return where they get credit for any eligible activities that they claim against this R&D tax credit. And so the reason it's so appealing or the reason why it's appearing on there is not that taxpayers are claiming the research credit in general. It's rather the issue is that certain firms are aggressively marketing R&D tax credits to taxpayers that don't necessarily qualify in the first place. So the article goes on to speak about like kind of like, is it still, are you comfortable in doing this, or are you rolling the dice on an audit if you're claiming the R&D tax credit? And so essentially what the article, to boil down what the article talks about is essentially like, yes, you can still claim the R&D tax credit and it's invaluable for eligible taxpayers, but don't be talked into it just because somebody, shows up at your door or calls you on the phone and essentially says, this is something you can do. You want to work with a qualified person that understands that tax credit. And I think, the article doesn't come out and say it, but I'll say it. Document. If you're going to claim one of these, you need to have the backup and the assistance of a qualified CPA that knows what they're doing to identify what's eligible for these and take a tax position that you'll feel comfortable defending if the tax man comes knocking and questions your tax credit. But I think I'd open it up. Do you think maybe this is like an overblown situation? Is it like one that shouldn't end up on that black box? Or have you guys had an experience with a consulting firm that maybe comes in and wants to aggressively chase these R&D tax credits? And maybe Ty, specifically, what's some advice you can give to our listeners, to make sure that you're on the right side of this credit if it is?
Yeah, I think, definitely have seen this. And I think the latest variation of this, I mean, any business credit, you have this potential problem. And I think you see the latest variation of this has been with the employee retention credit, with promoters going around and aggressively hawking it towards every company they could find. And so I think, I mean, the reality, zeroing back to the research credit is that being a former tax person myself and having worked the research credit with taxpayers, one of the things that I always advise taxpayers about it ahead of time is, look, there is a lot of subjectivity involved in the calculation of a research credit. And it's, in my experience, unlikely that on audit that you will sustain the entire credit. most likely the IRS will find, if they're looking hard enough, they will find something in which they disagree with the subjective judgments that you've made that will lead to reducing the credit that you take. So you have to have an appetite. If you're going to take this credit, you have to have an appetite for the fact that you might lose some of it in a final audit if you are audited. And the goal, in any kind of qualified tax advisor and working with a client on this, the goal is not that the credit is 100% bulletproof, because it would be foolhardy to say that you have documented enough that would make a credit totally bulletproof in most cases. I am sure there are some corner cases out there where the credit is so obvious and so clear that it is bulletproof. But in my experience, I've never yet seen a credit that is 100% bulletproof in terms of that it could never be argued in any way. So what I believe about that is that the goal should not be trying to make the credit itself bulletproof, but to have, as AJ talked about, have good documentation, good rationale behind your position such that the IRS doesn't feel the need to penalize you for a frivolous position or for a substantial understatement that didn't have any kind of tax authority behind the position that you took. That is, the IRS may disagree with you. You may lose, you may have to pay more tax because the IRS ultimately concludes that that they come to a different judgment about something in the calculation than you did, but the IRS is willing to accept that your calculation was made in good faith with substantial authority and therefore shouldn't be penalized. That is the goal of a good tax advisor on this point, in my opinion. And I think that, yeah, of course, this is a classic. Promoters out there who are chasing tax credits across a wide variety of clients and not necessarily doing the work, providing them with complete advice about their risk, about the risks involved and about what is likely or could happen, and not doing the documentation work. It is a classic case of moral hazard, because in the end, most of these kind of credit projects the fees are essentially charged somewhat proportional to the amount of credit that the company is getting. And so you're asking the business owners, the business operators, to take on risk for the advisor or the service provider to get a return, right? But the business operator obviously gets a return, but the advisor is getting a return in their fees, right? And the advisor is not taking on the same level of risk that the business owners are. I mean, they are taking on some risk. Yet, yes, the IRS will go after advisors who are providing bad advice or, constructing tax shelters and doing things. But there's a far greater risk that a taxpayer, the business, loses the tax and or is penalized than there is a risk that the advisor ever gets slapped, as a practical matter. And so the risks are not aligned. And so I think that people need to understand that the risk to your advisor is not the same as the risk to you, that as a taxpayer, you have far more risk than the advisor has in this equation. And so you can't just like throw up your hands and say, well, I had somebody advise me, so it must be good. You're at risk. They're not in most cases, or they're not as much risk as you are. And so you need to make an informed decision about whether you're going to take that credit and whether you're going to take on the risk that you take. That being said, I think it is a good business decision to take a certain amount of tax risk and to take positions that are supported, even if it's possible the IRS may disagree with you, but they are supported under the law. I think that is a good business decision. So I wouldn't discourage anyone from taking credits, but yeah, I think understanding and appreciate it, that it's your risk and you can't really pass that risk management decision off to an advisor. You have to come to terms with that yourself as the business operator.
I think that's exactly right. And I just want to add on, because I think the article brought up a good point that fits really well here, which is that the risk, like when let's say you file it or your buddy files it, because this is often what happens, the article talked about as one of the problems, is that someone files this on a return and they maybe weren't actually qualified to claim it. They get away with it for a couple of years because nobody notices. And so they turn around and tell all their friends, and then their friends who are doing the same kind of thing things end up claiming the same credit. And so their kind of determination of risk is based around two things: what their friends tell them or what the other business or entrepreneurs are doing. And then the fact that if they claimed it one year and didn't get audited the next year, they then get this feeling like they're done, they've done it, and they can now continue that on. And so I just want to expand on that point and say, well, your belief about your risk is sometimes not in line with how it feels in the moment. You file a return, you feel like you're done, you haven't heard anything more about it, and it's been 6 months. But the reality of that could be an issue, or that there could be a question on it, or that you're telling people to take it and they're not actually qualified to do it, is a risk that often gets understated unless you're out there talking to the people who got audited and had the credit revoked in some way or challenged. But we don't do that, right? There's no support group for people who have been rejected on an IRS credit. Instead, you get the salespeople who are going to sell it, get it out of the way, and then move on. And like you said, Ty, have made away with the money by the time that the risk actually comes due. And so I thought that was an interesting point.
No, I think really good points from both of you. And I think when I looked at this article, I was thinking of overarching kind of themes. And I think the theme that I got out of this was, and this goes with anything, R&D credits or any kind of accounting. I think if you're going to take a position, I think you need to document why you took that position and have the backup to support it. I mean, this goes well beyond just the R&D credit. I think, even something as mundane as like depreciation or, why are you choosing a useful life or something or anything, I think, I think taking a good position, documentation, I guess one of the things that I've seen lacking in the accounting world is good documentation or backup on why you're taking a position. You can never go wrong, and you'll never be penalized for documenting it. Even if you're wrong, at least you have the documentation of why you took that wrong step, and you can learn from it, and I think that goes a long way as opposed to just, well, that's what I figured, So I think documentation and backing up with some kind of support of, an explanation of what you're doing is never a bad thing, especially when we're talking about R&D credits. But Charlie, you got another article for us?
Yeah, I got an article from Apple News called FAA grounds Virgin Galactic, says it's investigating problems with Richard Branson's flight to the edge of space. And so what's happened is that there was the FAA confirmed late Wednesday that it's investigating the flight Unity 22 for claims that it went off course during its planned space flight. It had approval, and it had gone through all of these kind of things to get approval to fly, but didn't stick to the plan that it had laid out. It said that it was off track for over 1 minute and 41 seconds, that it flew below the altitude that it was approved to fly at. Richard Branson, the billionaire founder of Virgin Atlantic, was actually on the flight at the time. And the company, so they put it on hold. It can't fly anymore. But then the company came out and said, well, we're on a month-long self-imposed no-fly period anyway, so it doesn't matter if you don't want us to go to space or not. Stock dipped about 4% after that news came out. And so for me, it's interesting because, this is kind of a new business problem, right? We didn't have billionaires trying to fly into space up until somewhat recently on their own private kind of expeditions. And so I guess for me, hearing that things might go wrong and imagining this spaceship just veering off course makes me wonder, is it going to take a high profile catastrophic failure to bring all these billionaires back to Earth or what? What do you guys think?
Yeah, I mean, I guess it's hard for me to put in perspective how important that veering off course actually was. Because it almost sounds like just a technicality that the FAA is going after him about, right? On some level, but I'm sure there's more to that I don't appreciate about the significance of them being off course by that amount and what that could actually mean from a safety or from a community standpoint. I wanted to make note, though, of I think that the connection between, you mentioned the stock price and also the fact that they were announcing that, well, we weren't going to launch anything anyway during your time period, FAA, so it doesn't matter. I think that announcement is definitely connected to the stock price issue in the sense that they were trying to signal to the market, hey, us being grounded by the FAA is of no consequence to our business plan, because we weren't planning to launch anything during that period anyway, kind of thing. So I think that's what that piece is about from a financial standpoint. But in terms of from a engineering kind of standpoint of what does it actually mean that they were off course, and is the FAA just overreacting? I don't know. I mean, it sounds, it's too technical.
I guess when I read the article, what I got out of it from a business perspective was how much government regulation matters. I mean, we're talking in the article, it says that they were off course or they were below altitude for 1 minute and 41 seconds. Boy, that's a costly 1 minute and 41 seconds. And on top of that, for the FFA to step in and do something about this, even from a business standpoint, for 1 minute and 44 seconds of a plan that went awry going into space. I mean, wow. Like when you're operating, I guess, in these new frontiers of robotics and space travel and stuff, and you're dealing with essentially, government regulation, never underestimate the arm, I guess the strong arm of government regulation and the business impact it can have, directly tied to your stock price or your operating. I mean, I work a lot in the nonprofit sector, and, that's a huge thing that needs to be contended with is government oversight of programs, money, and all that stuff. And here it is again in private business where 1 minute and 41 seconds cost them, a lot of money in stock prices and got them grounded from flights for a certain amount of time. So I think, if we can relate this back to businesses that maybe listen to this podcast, it's just be aware of compliance out there and take the note, what the regulations are, and you're probably not going to see them all in your sites, but at least try to be aware of as many of them as you can and understand, the repercussions if you fall outside of that standpoint, I think is something to keep in mind. All right. That's our podcast. Thanks for watching the None of Our Businesses podcast. Make sure you smash the like button, subscribe. We noticed that a lot of the people that are listening aren't subscribed, so make sure you hit that subscribe button and ring the bell. We also have 2 other podcasts, the POP podcast, Profitless on Purpose, which is nonprofit focused, and a new crime accounting podcast. So make sure to check that out on your favorite podcast or YouTube channel at TCA. And until next time, we'll see you all later. Thanks and have a good day.
Thanks, everyone.
Thanks, everybody.